Good morning, everyone. I'm John Stockdyke, the editor of AccountingWEB. I'm sorry we started this Finance Act webinar a little bit late. We've been having technical problems represented, if you look on your screen, by the blue person, who is Rebecca Bennyworth. But we're going to struggle on through and hope that we can answer the questions you've all got and hear about some of the key features on the Finance Act 2014. Next along the line, moving to the left on the little small screens, is Kevin Hall. Kevin, can you hear me? And hopefully, if we can hear you, can you let everyone know who you are and what you do?
Well, I can certainly hear you, John, so hopefully you can hear me. I'm a VAT specialist at a firm called Gabel. We specialise in tax, and today I'll be talking about the one-stop shop.
Great, brilliant. Thank you very much, Kevin. And to your left on screen is John Hood, forgive me. John, welcome. Can you hear us? And are you part of this webcast?
Yes, good morning, John. I'm the head of tax investigations at Gabel, and I'm going to talk about accelerated payment notices and all the contentious issues arising around the new legislation by HMRC to get people to pay any outstanding taxes for tax avoidance schemes up front before any litigation happens.
Brilliant. Thank you very much, John. Our sound was a little bit odd there. I hope people can hear us. And say this is a I should explain, this is a very experimental prototype webcast, and pioneers sometimes do get the arrows in their back. This is something Taxcalc are supporting a project AccountingWEB doing across the whole finance bill cycle, so that this is the end of Finance Act 2014, and if we can get up and running, we might even touch on 2015. So at the December legislation release, usually, and after the budget, we hope to have these kind of just 45-minute sessions where people like John, Kevin, and Rebecca give an initial sort of orientation to what the issues that have been introduced and what problems they may cause for businesses and their advisors. Now, we can now see Rebecca on a new technology. Rebecca, can you hear us? And can we hear you?
I can hear you perfectly. Can you hear me?
We can indeed. This is your backup system, so let's cross our fingers.
So
it's been worth the wait, but can you tell us about yourself and apart from being very resourceful with technology?
Yeah, I'm my own IT manager. Yeah, I'm a chartered accountant. I'm chairman of the ICW tax faculty, and as I'm sure most of the people watching know, I lecture a lot on tax. That's probably enough.
Brilliant. Okay. Well, really glad you could join us, and thank you for. I on behalf of AccountingWEB and all our members, I would like to thank all of the participants in today's webinar, as well as giving up their time today for 45 minutes. So we've all had some pretty epic engagements trying to get on top of the technology, including just now. So that is brilliant. We're all here. We'll move on to the sort of detailed measures from Rebecca, Kevin, and John, but also as part of our tax policy tracking process, Andrew Goodall has come on board and is helping us. He's actually in the process of compiling summaries to the main sections of the Finance Act. So Andrew's done 2 articles. So the first part covered the income tax sections. There was also a complication on company cars and a whole sequence of issues around pensions, employee share schemes, seed enterprise investment schemes, venture trusts. So Andrew's assembled that material for us. He also has done a guide to the corporation tax and CGT chapters in part 1. And Kevin, of course, you may preempt some of Andrew's next work, because he'll then be later this week be doing something on the part 3. I think that's the VAT section, and he'll wrap up. So Andrew will probably do about 4 summary articles. This is more diving into the detail. I guess, Rebecca, when I've looked over sort of chapters 1, 2, and 3, I noticed that word capital allowances cropped up in both chapters 1 and 3, and I think that's the area you've sort of put your hand up for and mentioned the capital allowances. But before you get us started, are there any other quirks, quibbles, or interesting areas you think we should return to before the end of the morning?
I think, I mean, obviously we've got the sort of basic indexation on the personal allowance and things like that. I think the transferable personal allowance is something that will be interesting next year. It's been something that's been criticised quite a bit, but I think it's quite important. We've now got such a high personal allowance that families, couples, are quite often, at least one of them, dropping out the tax net. So I think this idea of a transferable allowance will be quite important to allow low-income families to actually get the benefit of the work that's been done on increasing the personal allowance. I think the really key points on capital allowances, sorry, I'm just referring to my Finance Act by my left hand. I think AIA, although on the face of it, most small businesses get all of their capex covered every year at much lower levels than $500,000. I think the thing for people, particularly in practice and smaller businesses, to be aware of is there are businesses which have what I could call a generational very large spend. So a farmer replacing a combine harvester probably happens once every 20 years. And I think it's quite key that both businesses and practitioners are aware that we've got this window. You're only going to have one full 12 months at $500,000 because most businesses will span, well, all businesses will span at one end or the other because we've got a different start date to a finish date. And it's particularly taking account of the transitional rules as you pass out of the new regime, the increased allowance, that people need to be careful of, because last time AIA went down, people got caught out very, very badly. So I think it really is something for people to look at, that final period as we come out of the $500,000, and also to brush up on their knowledge of when expenditure is incurred, because if you buy something on HP, you don't incur the expenditure until you put the asset into use. If you buy a combine harvester in November 2015 to get the tail end of these allowances, then you won't be getting your allowances because you won't use it until later on in 2016. So I think there's some key points there. And the other one on capital allowances I'll just touch on is the business premises renovation allowance. There's been a bit of tidying up and if I can say reining in, because it's been a bit of a subject of abuse, slight abuse, but don't forget it's there. Very valuable allowance, 100% on bringing redundant business property back into use as business property, and one of the very, very few reliefs not affected by the income tax capping measures that came in last year. So really quite yummy. Be aware that the designated areas order was reissued earlier this year, so we're on the new assisted areas order, so just be aware that changed. The new orders areas came in on the 1st of July, but definitely don't forget it's there, and think about how you might be able to advise clients on it.
Great, thank you, Rebecca. On one thing, this is might be a bit of a curveball or sort of something we hadn't talked about before, but capital allowances, they don't extend to cars. Am I correct on that?
The AIA doesn't know, certainly. I mean, cars, you're stuck with a writing down allowance of either 8 or 18%, unless you buy a very low emission car, less than 95, and you'll get 100% on it. Now, that limit will go down next March to 75, so if you're thinking about maybe investing in a low emission car in a business, then worth making sure you do that before the end of March, because 75 grams per kilometre is quite a tall order.
Brilliant. Okay, well, thank you for dealing with that. If any other of our listeners and people on looking in on this sort of have particular areas, we're hoping, and may I encourage you, if you are watching this, to use the chat box, the Cover It Live chat box on our homepage, and we'll try and bring in a question. For example, where? Okay, we have Peter who's wanting to know where a start is likely. But Peter, can you, if you are listening to this, could you tell us which start we're talking about? So we may return to Peter's query later. You may still be on, Rebecca, if there are more questions. But
Yeah.
let's move on now to I think it's Chapter 3 and VAT. And I know this is an issue, I think, or Kevin, first, if we look at the overall VAT scene, is it a particularly ugly or complicated finance act for your line of work?
Well, ugly is possibly a bit strong, but that's the side of the line I'd err on, I think, here. Mm-hmm. Essentially what's happening is a new set of rules which start next year, 2015, on the 1st of January. And to put it into context a little bit historically, for many years now, Europe's been trying to put a one-stop shop in place. The non-EC businesses for certain services already have a one-stop shop, which has been moderately successful, I'd say. And in 2010, obviously, we had the VAT package to change the place of supply rather fundamentally, and that includes this new one-stop shop measure from 2015.
Could you tell us, if you can hear me, Kevin,
yeah.
what exactly is a one-stop shop? I mean, maybe if you sort of talk us through how you would adjust to the changes, you can explain how it works. But as I say, I keep hearing the phrase, and
yeah.
I'm a bit vague on what a one-stop shop is.
Well, I was going to come back to an example, because I find they're the best thing to explain all of it in one go, really. So let's take an e-book, for example. What we're trying to do there is to change the place of supply from what is now the country of the supplier when they're supplying an e-book to a consumer within Europe. And in 2015, the place of supply will be where that customer is. So let's work through that in a little more detail. If we have an e-book and we're trying to supply that and we're based in the UK, we will be charging UK VAT this year. But for a B2C supply next year, we'll have to charge VAT in the country where the customer is, even if there's only one customer there. There's no de minimis limit for registration, so it could be quite a demanding change for the business. The one-stop shop idea is to simplify this requirement to register for VAT in each EC country. Now, that sounds quite attractive. The idea is that you would register for this mini one-stop shop scheme, the MOS, and you would complete the one return in the UK for all European countries where you're required to charge VAT in the customer's country. And the idea there is that that would be very simple, and that's a huge advantage. But we're left with many disadvantages here. What we're looking at are the requirement to issue an invoice, the requirement to determine exactly what qualifies as the kind of service that would fall into these new rules. Now, we're told, as a summary, effectively, that it's broadcastings, telecommunications, and electronic supplies of services. But what is, let's say, an electronic service? It's very difficult to determine whether a service that's supplied over the internet is supplied electronically, or whether it's simply a service of its own kind. I can give another example of that, just to illustrate what I'm saying here. Insurance advertising, unlikely to be a B2C service, I accept that. But there has been a case in the last few years two cases, Insurance-Wide and Trade and Media Group, where you put up a passive advert on the internet, and that is an advertising service. Do a little bit of work, you're being more active, you're gathering data, suddenly you're ceasing to be an advertisement and you're becoming an exempt insurance service. And how do you distinguish between the two kinds of service? And that's rather tricky, and the UK has a set of rules in place to determine that. But what if your customer is in Italy? I accept that for insurance, this is unlikely to be a B2C service, but we do still have that issue of how do you determine whether the service in question is going to qualify as an electronic service and become BTE, which is the acronym for that. So really the answer there would be to try and take advice in your customer's country or from a local advisor there who can tell you whether the service you're supplying is likely to be reverse charged or dealt with in that country as a B2C supply. Now, these are practical difficulties. So I would say that it's necessary for businesses now to start planning what their strategy is going to be. They need to take advice from UK advisors on what the changes will be, and they may well need somebody who can provide a European network to explain what the changes are likely to be in their customer's country. They may even need to consider whether certain countries are not worth targeting and maybe to adapt their software to make sure that the countries are blocked out and can't be for the customers. Do you have any questions on that, John?
Yep. Yes, Kevin. First, we were having a little bit of trouble with our sound. Was it sounding okay and working for you? Could you sound like you were struggling and manfully with a bit of a feedback there? Was it working for you, or was it as confusing as difficult for you as it was for us there?
I just talked to it, John. I can't.
Okay, so it's, okay. As I say, maybe the sound is a bit difficult. If you see me looking distracted, there is. I've neglected to, with all the sound problems, I neglected to put a piece of code on the site, so I may be a bit distracted. But Rebecca, I know you flagged up the mini one-stop shop and the place of supply issues to me beforehand, and I know you're sort of a small business yourself, and you have quite a few small clients like that. Have you, started to deal with people who are kind of flummoxed by what the one-stop shop and the change of the place of supply is likely to do? Can you give us examples of the practical problems they're already bumping into? Have you seen any?
Yeah, I've funnily enough, I've actually not got any clients who do the right things to be affected by this. A lot of my clients are fencers, hairdressers, and that sort of thing. But as you know, John, I'm also director of a very small tax software company, which is so small probably nobody's heard of it. So small we only registered for VAT 2 years ago, and now we find we're lumbered with this dreadful thing. Of course, as vendors of software, we sell software to practices, but also to individuals to complete their tax return for about 13 quid. Obviously up against a free HMRC product. We don't sell very many in this country, but the one thing we do is sell a lot abroad to people who are non-resident, because the HMRC free software doesn't cover non-resident pages. So if you're non-resident and you've got a UK tax return to do, you need to buy an electronic product, and there are only 2 or 3 companies in the market for selling to individuals, but we sell quite a lot of tax return software over the internet. Now what we're having to do is talk to WorldPay, who are our payment merchants, to find out how we're going to be able to harvest the information about the country of residence of our purchaser. I don't think we haven't got much worry about is ours an electronically supplied service. Downloaded software just is, so that's okay. But actually, you know, even as a very small company, we're having to think about making changes to the payment mechanism of the sale process in order to capture the data, and then I'm afraid Muggins is going to be the one actually doing the one-stop shop. I think one of the things that I'm really worried about for small businesses is that the MOS scheme is only available if you are registered for VAT in the UK. And if you're quite a small business and you're not registered for VAT, because we've got a high VAT registration threshold, then you cannot use the mini one-stop shop. So you're left with a horrible situation, either, even as Kevin said, even for just one sale in France or Italy or whatever, you'll have to register in that country, or you, in order to use the mechanism, you're going to have to register for VAT in UK and therefore bear VAT on your sales, and that might actually hit your profits. So small businesses have got an unenviable task. We did look at this, the ICAW did look at this in some detail, and we made some representations, but HMRC has taken Council's advice and been told that that would require a change of European law. And as I think they're not desperately impressed with us for having such a high VAT threshold, it's not high on the agenda. So small businesses in the UK that aren't VAT registered, they're facing a really difficult decision. But yeah, there's going to be, I'm sure, practical issues around this.
Mm-hmm. And Kevin, just before we move on to the next topic, I do wonder, you talked, Rebecca said, you know, software's okay and fine, and e-books quite clear, but you said there would be some potential anomalies and ambiguities about source of supply. Do you think the change of basis, or the change of where the VAT is assessed, do you think that's going to you know, will we see tribunals 2015-16 as a result of this change?
Well, first of all, I'd like to thank Rebecca for her comments. I think they're all completely valid. The one thing I would say is that we do have clients who are coming to us with this kind of question. We may well find some VAT tribunals in the coming years on these kinds of issues. The problem would be that you'd be, as a UK business, trying to work out, for example, whether you'd be fitting in that category, whatever the category is, in the overseas country. So I suspect you'd be looking at overseas businesses who might be trying to take cases in the UK tribunals. And for that, it's quite difficult to assess what might happen. Our clients seem to be quite highly populated with electronic apps type businesses. So if we're looking at somebody who's trying to supply a service via the internet, I would have thought, as Rebecca says, you download it, that software is automated, there's very little human involvement, so it just is part of this BTE MOS new rule from 2015 onwards. The problem that they seem to have is, how are they going to deal with this practically in terms of their software? Do they really want to be engaged with certain countries where they might only have the one customer, which would then oblige them to be registered in that country for VAT and to charge that there? Or would they rather put a block in their system so they don't deal with that country and they select only the countries that they wish to deal with and be registered there? They can use the MOS, but of course it has all the other practical issues that they need to consider.
Okay, thank you. I am trying to sort out a technical thing on the side, so sorry for the disruption and sorry for keeping you waiting there, John. Yeah, and it is sort of saving it last but not least, because I think Rebecca was quite, and others are exercised about the VAT rule changes, but I think the thing that probably vexes a lot of people is the accelerated payments and follower notices regime. Which part of the Act, I had just looking through the titles, it didn't leap out at me which chapter or which part of the Act people will find the actual clauses enacting the follower notice. Where should they look, John?
It's within Part 4, I understand. Yeah, Chapter 3.
So as I say, I'm at a disadvantage because my crib sheet hasn't arrived from Andrew Goodall yet. But
That's obviously a communication problem.
thank you. Great, thank you for that. Is it? I mean, I guess that's the thing. We have to sort of swallow the arguments, and there's if we reach the point of spilling over spilt milk, you know, can't actually stop this regime from being applied now. So what will be the practical implications? How will you go through this, and what recourse? If I'm not mistaken as well, did the Act not beef up the legal your right to appeal through the legal process? I think that was added, was it not, during the parliamentary debates?
Yes, there was some clarity on what your appeal could be and about reasonable excuse and how you can take the matter forward if you disagreed with the notice when it was issued to you. So that's very welcome for all of people that are affected by this legislation. I mean, obviously, from my perspective, the big issue is that obviously people were expecting to have to pay the tax if ultimately a decision was made by the court that their scheme didn't work. However, HMRC have now said, instead of having to wait for that court decision, you now have to pay up front and then wait for the court decision, or just pay now and wave the white flag.
Right. Okay, sorry, I am listening, but also still trying to fix that technical glitch.
Okay.
Again, can you take us through? I mean, I think probably with all the debates, probably a lot of people know the basic outline, but and is it very much important to look at the accelerated payments and the followers' notices separately, or do they really work in tandem? And if so, how does that whole process work?
Well, people who have a scheme which is affected by DOTAS or the GAAR, they could receive a payment notice over the next 20 months. Follower notices apply to tax avoidance schemes which may not be affected by DOTAS and were in existence before DOTAS, and HMRC have reached a court decision which allows them to write to people who they believe have a very similar scheme or case and say to them, as we believe your scheme is very similar to a court decision, a final decision, we can now ask you to pay the tax up front, even if you want to consider and continue with your litigation.
Right.
So it affects both people caught by DOTAS and people pre-DOTAS.
Excellent. Oh, okay. And again, we've talked about the sort of legal redress. Will there be any borderline, or do you envisage, you know, are there any borderline instances now that you're aware of, or do you think we will get into a situation where there might be, let's say, ambiguous situations for tax scheme promoters?
Well, I mean, I think the sensible advice is if you believe you could be affected by the accelerated payment note or the following notice, you should ask the promoter of the scheme for their opinion. Then, if you want further clarification, then you should obviously speak to a dispute resolution specialist to see what their opinion is as well. So, whilst I think there are some reasonable excuses why you may not be affected, the legislation is very tightly drawn so that it basically the opportunities to say I shouldn't have to pay the tax up front are limited.
And have you encountered any of the firms who Gabel works with? Have any instances crossed your desk yet of perhaps firms? I mean, I think there was the list of 1,200 schemes who were going to be notified. Have they percolated the system through, and are you aware of the notices now? How quickly off the mark is the revenue being with this? Basically, have any actual notices reached your desk in any way, John?
Well, they were meant to start coming out as of Friday. So as of this morning, no, I haven't seen any. But I know that a lot of people are concerned about the notices, and a lot of people have contacted me and said, well, I was expecting this to be resolved in, say, a year's time because it was going through litigation and the promoters had told me this. Now they're facing the prospect having to pay within, say, the next 120 days if they were to receive a notice in August, for example. So there's already a great deal of concern, and it's not just the high net worth or ultra high net worth individuals. There's a lot of ordinary people affected by this who've been taken advice, gone into a scheme, and now are facing the prospect, ultimately, of bankruptcy in most severe cases because of the 90 days to pay.
Excellent. Okay, Rebecca, I guess I know the tax faculty at the ICAW obviously responded on this issue, but are there any sort of post-enactment comments you might, the scheme, probably, the faculty's stance on aggressive schemes? I mean, maybe you could enlighten us on just briefly overview of what the faculty's view is. But is there any sort of mitigating advice or further issues arising after the Finance Act?
Yes, John, this is a difficult area because I know a number of members have said to me that they felt that the faculty of the ICAW should have fought this a lot harder. It's very, very difficult. We responded to the consultation in pretty robust terms. In fact, I've only seen one more robust response to a consultation recently, and certainly it would seem that HMRC were pretty determined to go their own way. But the problem is, you respond to a consultation, you give your views. It's up to the executive as to whether they take those views into account or not. And this is very much one of those consultations that HMRC's view was it was going to happen. I'm hoping that we've got some of the worst issues around appeal sorted out, and it certainly looks like it from the legislation. A lot of tax avoidance schemes that are sold now are sold based on deferral of tax. So I can understand why HMRC's view is that to neutralise, if you like, the effect of those schemes, they would want to bring in this legislation. So I can understand that. The fact is that aggressive tax avoidance is reducing very, very rapidly, and with the legislation in this Finance Act on affecting the promoters of schemes, I think it will virtually die out. I think we'll look back on Finance Act 2014 as really the beginning of the end of aggressive tax avoidance and marketed schemes, simply because I know of a couple of promoters who have just literally shut their doors in April. So, and obviously that's something in the political agenda in the current financial climate. Government feels that they really have got the people behind them to do whatever they choose on this front. That's what makes it particularly difficult arguing a case, because you don't really have a lot of support from public opinion. And even reading the newspapers over the weekend, still some comments about there's always a scabby accountant willing to sell the schemes. So I think it is very, very difficult to actually stop these types of development, and really it's just a case of trying to get something as workable as you can.
John, do you share Rebecca's view? This might be the end of marketed and stroke aggressive schemes as we know it.
I think this is a door firmly closing, because unless you go overseas and then offer this type of advice, I suspect no one in the UK is going to offer this type of advice. And Rebecca's right, a lot of the promoters, as I understand it, have decided to change their philosophies. I think one thing is worth highlighting is that HMRC believe about £7 billion is unpaid, and that 33,000 individuals and 10,000 companies are going to be affected by this legislation. And I think it really will stop people taking advice, because if it was sold that the worst case scenario was that you would have a cash flow advantage, and that's now going because of the new legislation.
Okay, thank you for that, John. Kevin, I guess we'd better sort of get towards the time to round up, because I know that Kevin has got to prepare for another meeting at noon. But you've been sitting there. I'll probably finish up by just going back over, working my way around the three of you, just to see if there are any other sort of supplementary points you might flag up to our members. And I will pass very quickly over the idea of direct debt recovery, because I think that's going to be Finance Act, or that'll be the legislation for the Finance Act 2015 that we will grapple with in December and beyond. But as I say, Kevin, you've listened to the tax avoidance issues and the sort of some of the direct tax things. Are there any other VAT morsels that you think are of that worth closer consideration by general practitioners and businesses?
Well, there was very little in the Finance Act for VAT this year. The only thing I'll probably mention is the prompt payment discount, which is changing. Currently, if you issue an invoice and you knock off, let's say, 10% for an early payment, you charge VAT on the discounted amount, the lower amount, 90%. Well, it depends on the service, but for most services, from next year, 1st of April, you have to account for VAT on the full amount, and only if that discount is taken up would you then account for an adjustment in your VAT record. It's probably quite important to note, but I think most people shouldn't have any difficulty with it. If you've got any questions, I'll be happy to answer these as well.
And again, John, any other area niggles or interesting snippets that you'd alert us to? I mean, we may not be able to have time to go over them all, but at least AccountingWEB can follow them up and people can research them themselves. So would you point them at any other areas in your domain of advice and activity?
Well, you mentioned about the direct recovery directive and money being taken out of a bank account. I mean, obviously this is a totally new concept to us in the UK, and whilst it's been in existence in Europe for a number of years, it's still a concern that HMRC are now judge and jury on what money should be taken. And one of my concerns relates to joint accounts, where someone could owe HMRC money, say £10,000. That payment is not made, and HMRC obtain details of bank accounts, including joint accounts, and then payment taken from a joint account. Well, my concern is what happens if, with a joint account, the person who owes the money hasn't put anything into the account. It's the other party who actually would suffer the deduction. So that does cause me concern. Even though there are restrictions, it could be that, for example, if I had a joint account with Kevin, he could be paying my tax. Now, that doesn't seem right. Well, not from Kevin's perspective.
He's not looking very enthusiastic about that either. Yeah. Okay. And I guess Rebecca, maybe I'll go to you finally, if as well as maybe selecting any other potential niggles or things to look at more closely in the Finance Act. Maybe do you want to, right? Since we have you in the thing, I think maybe it might be more better if you sort of sign out and give us your final just your verdict on the Finance Act 2012. Although I think your comment, your soundbite earlier about the tax avoidance certainly will be the line I remember from the event. But as I say, what's your final wrap up?
I think in terms of other points to look out for, do look out for the changes on benefit in kind on company cars. Those rates are rattling up very quickly, and in particular for those who've chosen quite low emission cars, the benefit rates are rising, and this Finance Act is just one of a series where actually there is no hiding place, and company cars represent pretty poor value for money nowadays, in even the low emission ones. So I think just keep an eye on that. We've got the rates through to the end of tax year 16-17 now, and they're not good news. So bad news on the company car front. As I said, I highlighted the married couple transferable tax relief. I think that's quite important. I know people regard it as a complex. I do think it fulfills an important social role in terms of enabling less well couples to benefit from the increased personal allowances. I don't necessarily go a bundle on the whole married couples thing, but I think it's important. But yeah, what else could I round up on? I think a bit of a mixed bag. I think tax avoidance is the real front and centre of this Finance Act. There's a lot on indirect taxes in it, betting duty and all of that type of thing, which I'm quite relieved I don't need to write about or lecture on. But I think if I can sign off on the direct recovery thing, the consultation has closed, but in my view, HMRC haven't heard the last from us or anybody on this subject. It is something which I think is entirely unconstitutional, and I'm going to take a quote from our Wyman debate, which subtitled this "A Power Too Far," and I think that describes it very well. So I think there's going to be more from our very concerned members on this over the autumn, because it is a huge worry.
Right. Well, thank you very much. That's very tidy indeed for both of you. So I think we haven't really totally wrapped up Finance Act 2014 because there is a lot of detail in there. But I think as a quick overview, I can't thank the three of you enough for coming to our aid and also going through all the teething pains that being online pioneers can sometimes entail. And as everyone has heard in the past 5-6 minutes, we're also very much now looking ahead to the evolution of clauses going into the Finance Act 2015. I hope Rebecca, you, Kevin, and John, that you'll be along the way with us. On behalf of all the AccountingWEB members, I would really like to thank you for your time today, and for our sponsor Taxcalc, who made this interesting experimental webinar possible. We hope all of you can join us next time for something a little smoother and even more informative than today has been. But again, thanks to all our experts, and goodbye.